Stops is something which is a nightmare for many traders. And when you look at stops, this is the number one asked questions which I get. There is no universal stop strategy which is going to work. Stop is a subset of your trading setup. So stop is specific to a trading setup. If you are going to be trading a pullback, the kind of stop or the percentage stop or the where you put a stop is going to be different from if you are trading anticipation kind of a setup. Anticipation by definition, you want to get into a setups. Anticipation setups are so called volatility contraction setups. You want very close stop. Having wider stops on volatility contraction is going to defeat the purpose of trading a setup like that. Similarly, if you are trading a breakout kind of a setup, stops is a function of what kind of a profit which you are expecting. If you are expecting profits of only 8 to 10%, and if you are putting stop itself of 8 to 10%, it just doesn't mathematically make sense. So stops is a function of your trading system, and you cannot in isolation just keep saying, oh, where should I put my stop? If you have a stop problem, invariably it means that you have a setup problem. Supposing, let's say, and let's go to telechart to see this in terms of, like, say, if I am trading a breakout or a breakdown kind of a strategy, like the breakdown to the downside, and if I'm trading this, logically my stop can be put at the high of this day when I'm shorting, or I can put it even at half of the day, because the whole idea of shorting something like this is that there is a range expansion and the stock is going to move in the direction of the range expansion. As against this, if I'm looking for a setup which is an anticipation kind of a setup, right? If I'm looking at, say, here, and I see that this stock is having a very small 0.63 or 63 cents move, and it's like really setting up for possible breakout here, right? Putting in a wider stop is not going to be of any use, because the whole idea of entering something which is up or down 0.71% is that you want to put a stop as close as possible, and you want to not be having a wider stop in this particular case. So this is another thing which is like what is important to understand, that as a professional trader, your objective is to find a stop which is as close as possible, because the wider your stop, what is going to happen is, the wider is your stop, what is going to happen is you are going to have to find a move which is going to be much bigger move. But if you are a professional trader looking for, like, say, 20% kind of moves, 10% kind of moves, then your stop, if you are going to look for 10% kind of moves, and if you're going to put like 5% stop, it might make sense, but I would try and make even a stop which is even smaller than 5%. If you're looking for a 20% move, you put a 5% stop, it makes sense. If you're looking for a 100% move and you put a 20% stop, it will make sense. So first you have to determine what is your holding period and what is your strategy. Many investors don't have stops. And how do they still make money? Is because they control the position size. So they will put 20 positions of 5% size. If you put 20 positions of 5% size, then the size itself is a stop, right? And that is why you'll see many mutual funds don't have stops. Why? Because they carry 100, 200, 300 positions. So the absolute size of their position itself is 1% of equity or 0.5% of their equity. So that is why they can manage the risk, because what is the worst case scenario? If it goes to zero, you're going to lose 0.5%. And because they are using a stop strategy like that, they don't have spectacular returns. So as a professional traders, your objective, or good traders, not everybody has that objective, but good traders who are looking for making a lot of money with the lowest risk, their objective is to find setups where the stop is very close to their entry. When I started trading, I used to typically put stops which are like a wider stop. I used to put stops below the consolidation. If I was buying a breakout, say if I was buying a breakout, I used to, like, say, for a breakout like this, I would put a stop below this consolidation. As I got more and more experienced, I started like putting a 2 day low stop. Then I started putting low of the day as a stop. Right? Nowadays, most of the time, I put my stop not even at low of the day, but half of the breakout bar. Do I get stopped out because of that? Yes. But if a stock is really going to make a move, it doesn't come. The one which is going to take off is the one which doesn't come and even go half of the day's breakout day. Right? So if I'm buying a breakout, nowadays I put a stop at low of the day, and during the day I will move it because the stock has moved in my favor, and I might have a stop which is like just half of this candle or sometimes even higher than that. Now if I'm buying something which is a anticipation kind of a setup, which is what I like to do a lot, because in that kind of a situation, in this particular situation on this particular day, if you're looking at, right, say this is 0.01%, just 1 cent, right? Now, if it starts breaking out and you get in early into these kind of setups, your stop is going to be very close. You don't need to put a wider stop for this kind of a setup to work. Either it is going to work or it is not going to work, right? And basically, after such a contraction in volatility or such a small range bar, the next bar is going to be a wider range bar. And if you can find setups like these where there is a very big contraction or there is a very tiny narrow range day, if you look at setups which have very nice tiny narrow range day before breakouts, and if you can create a watch list of those kind of stocks and operate from that kind of then you can reduce your stops, because then you can have very close stops. In fact, in a situation like this where you had like this particular stock having just 0.01, you can get away by putting a stop which might be even 0.5%. Now with the 0.5% risk, once it broke out, you can make a lot of money, because then here on this day itself it went up 4% and then like over the next 4-5 days. So in order to improve your stops, what you need to do is you need to basically look at setups inherently which require close stops. So if you're looking to make money and stops is giving you a trouble, which is what is I hear from a lot of people, then you have to go back and rework your strategy. When I started trading, I used to put an average stop which was around 8%, because that is what everybody tells you, or that's what you hear, or you read O'Neill's book and it says 8% stop. So you start putting 8% stop. You don't know better things to do at that time, right? As progressively I become a better trader in terms of selecting the right kind of setups and also researching the right kind of setups and operating from a watch list and entering early. Progressively I have reduced my stop to levels where many times or most of the time I get away by putting in 2.5% to 3% stops nowadays. So when you operate at 2.5% stops, you can capture a move of 10% and it still makes sense because your stop is only 2.5%. The other solution which you need to really think through, and which a lot of people who have stop problem they do not think through, is stop is a function of the price of the stock which you are trading. If you are primarily trading low price stocks, which are stocks which are priced below $5, you can dream of putting a stop of 2.5%, but you are seldom going to get an opportunity to put a stop at 2.5%. By very nature, lower price stocks have higher volatility. Whenever a stock has a higher volatility, the stop needs to account for that higher volatility, because otherwise the volatility is going to stop you out. So inherently, if you are trading lower price stocks, there is no way to have very close stops unless you go on an intraday time frame. Even if you go on an intraday time frame, having stops of those magnitude will be very difficult. But as against that, if you are trading high price stocks, which is what I primarily trade, I trade stocks priced above $100 most of the time. Those stocks don't have the same volatility as low price stocks. When they move, they are not going to move in 20% increments. They are not going to make 40% move in 3 days, right? They move in smaller increments. As a result, you can put close stops. And the advantage of that is that if you can put a close stop, you can put larger size. So if you have an instrument which is very volatile and it requires 20% stop, you cannot put 100% of your account or 50% of your account in that, because that will be too much risk. But if you are into higher price stocks, and in higher price stocks you can get away by putting stops of 2%, 2.5%, sometimes even less than that, then it allows you to take a larger position. And net you are going to make same amount of money, because if you put large amount of capital at work and you get it 8-9% versus you put only 5% of your account and you get 20%, the effect is going to be different. So there is and let's look at this one higher price stock to understand this. This is also a higher price stock, right? And this is a higher price stock, but more so, let's look at a stock which is say Aristanet. Now if you look at Aristanet, right, when Aristanet has breakouts and all, many times those breakouts are not really of very high magnitude, or even when it has a breakdown, they are not of very high magnitude, right? And they are here, this is a 3.83% breakout, right? And from there the stock goes on and makes $12 move, right? So you can get away here by putting in a stop which is around 3% or even less than 3%, half of this candle kind of a thing, and then it will work. High price stocks, higher you go, more likely that those kind of stops are going to work. One of my favorite stock to trade is Autozone. Okay, in Autozone, many times when it breaks out with just 2% move, right? 2.28%, and you risk 2.28% and you make 6%. That is still 1:3 thing, and it runs very smoothly. And every time you see and it breaks out, it doesn't break out with a very large moves. It breaks out with 2% move in 2%, and it goes up 6-7% after that. So, and in fact, and if you do a good job of finding anticipation setups on this kind of a high price stocks, many times you can get away by putting even closer stop than 2%. Now, if you study higher price stocks, you will find a lot of opportunities like this, where they will have moves which can be multiple dollar moves, right? Here, Amazon, when it breaks out with only 2%, and then it goes up and it makes 5-6%. And if you look at dollar terms, you're risking around $71 to make $222, right? So if you're looking for improving your stop strategy, one of the ways in which you can reduce your stops is by trading instruments or stocks which are lower volatility. Means higher price stocks, you can have close stops. Similarly, a stock which has a lower liquidity requires wider stop. A stock which has very high liquidity doesn't require wider stop, because higher liquidity stocks are stocks which are larger capitalization or higher volume. Like if you are trading stocks which trade $100 million volume a day kind of a thing, some of them will be very volatile, but most of them will be not the volatile kind of stocks. And as a professional traders, then you can put in very close stops and get away by putting a very close stop. Now, if you are trading higher ADR or ATR stocks, which is like the average daily range or average trading range or whatever people call it, inherently, if you are going to select those stocks, unless you find a buy point in them where you can time the entry or low, you will not be able to get a stop which is very close stop, because you are selecting an instrument which has the tendency to make bigger moves. So you need wider stops. Okay. So understand, it's very critical to decide your stop strategy based on what instrument you want to trade. Like some people want to trade low price stocks. If you're going to trade low price stock, realistically, you will have to have a stop percentage which is in line with the price of stocks which you are trading. Right. Second, very important thing which is which can improve or lower your stops is finding and anticipating a move allows you to have a close stop. Because if I'm coming with a watch list, I'm watching, I have a price alert, and I see the stock just starting to break out and I enter early in a breakout, stop is going to be closer. If I wait for a confirmation, of a breakout, if I wait for a confirmation of volume and I get in late, stop is going to be wider. So in order to improve the stop and increase your success ratio, finding and entering early, the earlier you can find and enter a stock, the closer is your stop going to be. Not finding and enter early is one of the ways in which you can reduce your stop substantially. Now again, this is an art, right? And it is an art to find and enter early. And it also boils down to some people's personality. Some people want all the confirmation in the world. They want relative volume to be 1.5 times the average volume, and they want all those things. If you are one of those traders, then you'll have to live with the fact that you'll need wider stops. Wider stops are needed as a function of what confirmation you're looking for. Closer stops will be possible if you enter the same setup early, but then that is going to lead to failures. Sometimes it will lead to failure. So you'll have to live with that. So these are some of the compromises which you have to do when you're looking at stops. Primarily, I am a person who's looking for a very low risk opportunities. So I have restructured my trading. I have rethought my setups. I have reworked my setup to reduce my stop level as low as possible. I'm primarily interested in making money with the stops of 2.5 or less. So as a result, I trade higher price stocks. As a result, I focus more on finding buy points where the risk is very low. I focus on finding and entering early. I focus on getting into stocks in the first 15-20 minutes as they're breaking out. And all of that is to reduce my stop. So there are a number of things which has to fall into place if you want to reduce your stop. The second is really, the next thing is really that many people who come to me and say that stop is a strategy, and then I ask like what kind of a trade you are doing, or show me your last 5 trades, or show me your last 10 trades. Then when you start looking at it, their problem is not stop. Their problem is the setup inherently which they are trading is not the kind of setup which you can get away by putting close stops. Or they have a setup problem, or they have a process problem that they are working, so they enter late in the day, or they enter next day. As a result, they need to have wider stop. So stops have many facets to it. There is no universal stop. If you are having a problem with stop, you need to think of multiple things. You need to think of the price of stock which you are trading. You need to think of the time frame which you are trading. You need to think of the kind of profitability which you are targeting for. You need to think about your timing of the entry. You need to think about the chart pattern which you are trading, or the particular method which you are trading. And then if you take all those factors into consideration, then it is possible to reduce your stop level dramatically. So examine your stop strategy as part of your overall trading, and try and find, if you want to be a professional trader, try and find situations and setups which involve very close stops. And if you can do that, then stop will not be a problem for you, and you'll not be complaining about stops.